The most powerful AI companies on Earth are getting ready to sell you their stock. And at first, that sounds like the moment everyone has been waiting for. For years, ordinary investors could use the products, watch the headlines, and hear about the insane valuations, but they couldn't actually own the companies at the center of the AI boom. OpenAI was private. Anthropic was private. The biggest gains were locked behind venture funds, early employees, and billionaire backers. Now that may be changing. OpenAI has submitted a confidential registration statement. Anthropic has done the same. Reports suggest some of these companies could eventually chase valuations so huge they almost stop sounding real. To most people, this looks like the front door to the future finally opening. But in finance, an open door is rarely just a favor. Every stock sale has two sides. One person is buying because they believe the future is worth more than the price. But someone else is selling because they would rather have the cash. And in an IPO, the sellers are not random people on a trading app. They are founders, employees, venture funds, and insiders. These are the people who know the company better than anyone else. They have seen the numbers the public has not seen. They know the real costs, the margins, the risks, and how much money is being burned just to keep the machine running. So when those people look at one of the most hyped industries in history and decide this is the moment to let the public buy in, there is one question worth asking. Why now? Because artificial intelligence can be real, powerful, and world-changing, and still be a terrible investment at the wrong price. The internet was real in 1999. It still crushed people who bought .com stocks at insane valuations. Housing was real in 2006. That didn't stop millions from getting wrecked when the market turned. Most bubbles are not built around fake ideas. They are built around real ideas that get priced like they can never fail. And that is where AI starts to look dangerous. An IPO sounds glamorous. It feels like a celebration, a company stepping onto the world stage. But stripped down, an IPO is also a liquidity event. Early holders finally turning paper wealth into real money. The public sees opportunity. Insiders see liquidity. Both can be true. That doesn't mean insiders are evil. It means they are rational. If you helped build a company from nothing, and the market was willing to value it at a number that assumes years of perfect execution, why wouldn't you sell some? Selling can be reasonable for insiders and still be dangerous for the buyers on the other side. That's the part the excitement hides. The roadshow talks about growth, vision, market size, and the future. It does not usually lead with the simplest truth in finance. The people who know the most are selling to the people who know the least. And once you understand that, history starts to look familiar. The names change, the technology changes, the slogans change, but the rhythm is almost always the same. A news story captures the market's imagination. Money floods in, valuations stretch, skeptics get mocked. Insiders and bankers bring more supply to the public while demand is hot. Then when the mood cools, the people who arrived last realize they were not early. They were exit liquidity. The .com bubble showed this perfectly. The internet really did change the world, but many investors were wrong about the price, the timing, and the companies that would survive. The SPAC boom showed the same pattern in a different costume. Celebrities promoted them, Wall Street packaged them, retail traders chased them, then many collapsed when the mood changed. Again, the costume changed. The trade did not. Now the costume is artificial intelligence, and this costume is much more convincing. AI is not imaginary. Developers use it to write code. Students use it to study. Companies use it for customer service, marketing, research, and internal workflows. The products are real. The usage is real. The excitement did not come from nowhere. But that is exactly what makes this moment dangerous. The better the technology looks, the easier it becomes to ignore the price. People do not feel like they are speculating. They feel like they are accepting the future before everyone else. The first warning sign is the spending. AI is often talked about like software, but the economics look much heavier. A normal software company can build once, host cheaply, and sell to millions with high margins. AI does not work that cleanly. The most advanced models require enormous compute to train, then more compute every time users ask questions. Behind every magical answer is a physical machine somewhere burning electricity, using chips, cooling systems, data centers, networks, and expensive talent. This is not just software. It is an industrial arms race with a chat box on the front. Reuters reported that OpenAI co-founder Greg Brockman said the company projected around $50 billion in computing power spending for 2026. One company, 1 year, just computing power. That kind of spending can turn explosive revenue growth into a treadmill. Because revenue is not profit, and hype is not cash flow. OpenAI's revenue has reportedly grown quickly, but reports have also pointed to heavy cash burn and huge losses, with exact figures varying depending on what is counted. That is the tension nobody wants to sit with. The public sees the product, the insiders see the bill. The public sees a magical chatbot. The insiders see chips, power contracts, training runs, failed experiments, cloud costs, talent wars, and competitors trying to copy every advantage. The business might work incredibly well, but the valuation has to leave room for things to go wrong. And right now, many AI valuations appear to leave very little room for disappointment. If a company is priced like it will dominate the future, crush competitors, lower costs, keep customers, satisfy regulators, and become wildly profitable, then merely doing well may not be enough. It has to do almost everything right. That is why AI is the future does not answer the investment question. The future can be real and overpriced. OpenAI's confidential filing does not guarantee an IPO tomorrow. Anthropic's filing does not guarantee one either. Timing, valuation, and final terms can all change, but the signal still matters. It shows the path to public markets is being prepared. A public listing can raise capital, create liquid stock for employees, help early investors return money, and give the company a currency for acquisitions. The issue is not that going public is automatically bad. The issue is timing. Companies tend to go public when they can get favorable prices. That is not a conspiracy. That is the point. When a company goes public, the public may think they are finally being invited in early. But early compared to whom? Early compared to the next 100 years, maybe. Not early compared to venture funds that bought years ago. Not early compared to employees holding shares from when the company was far smaller. Not early compared to insiders who watched the valuation climb before the public ever got a chance. Those people are not buying from you. You may be buying from them. This is why democratizing access deserves skepticism. Access is not always a gift. Sometimes access arrives only after the private gains have already been captured. The private investor who bought early can be wrong about a lot and still win. The public investor buying during peak excitement has much less room for error, and room for error is everything. If you buy something cheap, the future does not need to be perfect. If you buy something expensive, the future has to behave. AI valuations often seem to ask the future to behave perfectly. Demand must keep growing, costs must fall, customers must pay, competitors must not destroy margins, regulators must not interfere too much, capital must remain available. If even a few assumptions wobble, the stock can fall hard without the company actually failing. During a frenzy, people rarely ask hard questions. They say, "I just want exposure to AI." But exposure at what price? Through which company? With what dilution? Against what competitors? With what margins? With what timeline? If you cannot answer those questions, you may not be investing in AI. You may be investing in a feeling, and feelings are exactly what insiders sell into when markets get hot. They sell certainty to people who are actually buying uncertainty. They sell the dream after the dream has become expensive. This does not mean every AI IPO will fail. Some may become legendary winners. But the actual returns will depend on something far less glamorous than demos and headlines: cash flows, margins, dilution, and price. That is where the dream becomes a business or becomes a lesson. The most dangerous part of the AI market is not just hype, it is the fear of missing out. People are afraid of missing the next Microsoft, the next Google, the next Nvidia. That fear is understandable. But missing a rally hurts your ego. Buying the top hurts your account. So if major AI companies eventually hit the public markets, the smartest response is not blind excitement or automatic rejection. It is discipline. Ask who is selling. Ask how much they are selling. Ask how much money goes to the company versus existing holders. Ask what margins look like after compute costs. Ask how much cash is being burned. Ask what happens if the market stops rewarding losses. These questions are not negative. They are basic. Maybe AI really does change everything. But the stock market does not pay you for being right in the most general way. It pays you for being right at the right price. And if the people who know these companies best are choosing this moment to open the door, maybe the smartest thing you can do is not rush through it. Maybe it is to stop and ask the question nobody asks during a celebration. If this future is so valuable, why are they so eager to sell it to me?